Who pays for disruption? How capital decides winners and losers. Kodak, BlackBerry, Blockbuster, Sears. At some point, they were all number one. And then, they weren't. On the other side, you see Amazon, Netflix, Tesla, Airbnb. We usually tell this as a simple story. The disruptors were smarter, faster, more innovative. But that story is incomplete, because disruption doesn't just create winners. It redistributes costs. So the real question is not who disrupted whom. The real question is, who actually paid for it? We use the word disruption constantly, and mostly incorrectly. Incremental innovation makes products better. Radical innovation makes them different. Disruption changes the economics of an entire market. Clayton Christensen's key insight wasn't about technology. It was about where disruption starts. Disruptors don't attack the core of a market. They enter where margins are low, customers are ignored, and incumbents don't feel threatened. And then, slowly, they move up. Every business is a value system. On one side, customers. On the other, suppliers. Customers have a willingness to pay. Suppliers have a willingness to sell. The total value created is the gap between the two. Price and cost decide how much value is captured. Here is what disruption really does. It doesn't magically increase willingness to pay. It pushes prices down and restructures costs. Amazon didn't make people love shopping more. It crushed logistics costs. Airbnb didn't make travel more desirable. It turned unused apartments into supply. Netflix didn't invent content. It changed access and destroyed pricing power. Disruption often increases consumer surplus, but it compresses producer and supplier surplus. Someone gains convenience. Someone else absorbs the pressure. Now look at incentives. For a disruptor, upside is asymmetric. Costs are variable. Failure is survivable. For an incumbent, costs are fixed. Margins fund stability. Failure is internal, visible, political. Acting early often means destroying your own profit pool, which is why incumbents don't ignore disruption, they delay it. At this point, disruption still looks almost painless. Cheaper prices, better experiences, faster adoption. But disruption is not cheap. It's just that capital pays first. Amazon lost money for years. Uber still struggles to generate consistent profits. Spotify only works because investors absorbed a decade of losses. This is what rarely gets said. Disruption does not eliminate costs. It moves them forward in time and onto balance sheets. Venture capital, growth capital, and public markets act as shock absorbers. They finance years of negative margins so consumers don't have to. Incumbents usually can't do this. Their losses are immediate, visible, and politically costly. So disruption feels painless, not because it is, but because capital subsidizes it. But capital doesn't absorb disruption forever. At some point, the costs surface. And when they do, they don't show up in innovation headlines. They show up in layoffs, supplier bankruptcies, shrinking towns, disappearing skills. Think about retail after Amazon. We talk about cheaper prices. We don't talk about store managers, logistics subcontractors, local tax bases, regional employment ecosystems, or taxis after ride-hailing platforms. Drivers became independent. Risk shifted downward. Stability disappeared. Disruption often works by pushing costs down the value chain, toward the least protected actors. Consumers save money, and platforms scale. someone else absorbs the shock. Who benefits from disruption? Consumers, through lower prices or better experiences. Disruptors, through growth and market power. Investors, through asymmetric returns. Who pays? Employees, through layoffs and wage pressure. Suppliers, through margin compression. Regions through industrial decline. And often, incumbent shareholders too. Not because disruption is inefficient, but because value moves faster than systems can adapt. At this point, disruption can start to sound inevitable. But most disruptions fail. Not because the technology is not good, but because value capture breaks down. Disruptors who failed lacked cost discipline, timing, and capital patience. Disruption only works when costs fall faster than prices, capital stays long enough, and scale arrives before cash runs out. Disruption isn't destiny, it is a selection process driven by capital. This brings us to the conclusion. Here is the hard truth. Disruption is not just innovation. It is a reallocation of economic value. Old industries, incumbents, and unprotected workers absorb costs, while new entrants, consumers, and investors capture upside. Schumpeter called this process, old industries being replaced by new ones, creative destruction. AI is compressing labor and knowledge costs. Sustainability is forcing capital and industries to reprice risk. Value is moving faster than companies, workers, and institutions can adapt. The question is no longer whether disruption will happen, but who is structurally positioned to absorb the cost.